Hello, my name is Scott Dahl. I would like to welcome you to another one of my podcasts. Thank you again for tuning in. This is a timely podcast because what I'm going to do is I'm going to introduce a new technical indicator to you. It's not new, but it could potentially be new to you, which is called a double top because we're experiencing that right now. And I want to show you what it is and how it works and what it could mean for the future price of the market. So let's go right to it. This is a chart of the Dow Jones Industrial Average. Now you can see that the Dow Jones, this is, remember the green bars are daily up days, the red bars are daily down days. This is a daily chart. It goes back to May of last year. Here's the time across the bottom. Here's the price across the top. We're currently at about 38,500 in the Dow Jones Industrial Average. Double top. So we rallied up here. We hit this area of significant resistance. The market bounced off that. It created some support here in this congestion phase. See my arrow? It rallied up again. It tried to breach that ceiling, and it couldn't do it. Price got a little bit higher, but it just couldn't break through. So that's actually even could be construed, in my opinion, even more bearish. So you've got a double top. You've got a heavy area of resistance, and you've got a ricochet. You've got to bounce off that. That's this sell-off. So we could be in a short-term to intermediate downtrend as exemplified by this Dow Jones Industrial Average. I mean, I've seen triple tops. I've seen quadruple tops. Those are even more ominous. And so this double top, this is important. We might come down and find in this, see this support area here. We might find support here. If we break through that, then there's a good probability or possibility that we're headed lower. Now let's talk about Dow theory. If you go back about 2 months ago, I did a podcast titled Dow Theory Explained. If you would please go back to that, that'll explain in a little bit more detail what Dow theory is. In a short explanation, Charles Dow, he took a Dow Jones Industrial Index, he took the Dow Jones Transportation Index, and he used them, the movement of the two of them together to predict future price trend and just exactly what trend we're in. So we're going to take a look at the Dow Jones Transports in comparison with the Dow Jones Industrial Average, and here they are. You can see the Dow Jones Transports, transportation stocks, they've been in a downtrend since April. They've been heading lower. And if you go back to the Dow Jones Industrial Average, well, it broke trend, but it rallied back up. So you had the Dow Jones Industrial Average that was fighting for higher highs right here, and that you had the transports that were in a well-defined downtrend for about a month and a half before the Dow Jones Industrial Average topped. So this was what's called non-confirmation. You had the transports that were going down. You had the industrials going higher. Well, not anymore. So what happened was the Dow Jones transports proved to be the big weight, and that's pulling the Dow Jones Industrial Average down as well. So now you've got downward confirmation of the Dow theory, and that's another negative here at this present time for the market. To add to that, you've got the Dow Jones transports that are making new lows. So if you look at this, look at the Dow Jones, look at the transports, look at the price move, we're in a sell-off. Let's take a look at the New York Stock Exchange. I've got a chart of the New York Stock Exchange up. So you remember that the S&P 500 and more importantly, the NASDAQ indices, they are dominated by tech stocks, and tech stocks are the majority of the returns, and they have been the majority of the returns for these indices for the last couple of years. However, with the New York Stock Exchange, it's not that way. It's more broad-based. It's not as tech dominant. There's over 2,000 stocks in the portfolio. Look at that chart. What do we have? We've got a double top. We have a double top here as well, similar to what we saw on the Dow. I'm going to blow this up. So we've gapped down through that 50-day moving average, which is, I explained last time, was important support. So we have a down move in the NYSE as well. Let's take a look at breadth. Remember, breadth is extremely important to me. It's important to any technical analyst or any person that's participating in the market that should be, because you need a lot of stocks participating in an up move. So what's happening to breadth? Here's a chart of breadth. Here's a chart of participation. So you can see that it made new higher highs, and it looked like it was pulling the market higher, and what it did is it failed. So what this chart shows me is that less and less stocks are going higher, and that's a negative sign. That's a weight for the overall market, particularly the New York Stock Exchange. Also, you can see that the breadth gapped down today. It just happened to gap down today as I'm recording on May 29th, and it went down below the 200-day moving average. We have a sell-off. We have a sell-off in the Dow. We have a sell-off in the broad-based New York Stock Exchange. So I want to emphasize that we're we're in a high inflation, high interest rate, secular, a long-term bear market. Inside this secular bear market, you're going to have cyclical bulls and cyclical bears. We're in a cyclical, a shorter-term bull market in a high inflationary, high interest rate, secular bear market that could run for years. If you have not watched the podcast Secular Bear Market, I put it up about 3 months ago. What it does is it explains it to the best I can exactly what's going on and why I believe this. So high inflation, high interest rate, secular bear market. What's going on with the inflation? Well, I want to show you a chart that could kind of fundamentally sum it up. It's just an excellent visual. So this chart, this came from the Heritage Foundation. They actually pulled the data from the U.S. Department of Treasury. It's data that's out there. It's very telling. If you look at government debt, it took from, so this is a staggering pace of new debt, total outstanding debt in trillions of dollars, government debt. You go back to the mid 1700s, it took from the mid 1700s all the way to 2020 to reach 7 trillion in government debt. From March of 2020 to what I believe was June of 2022, the government added another $7 trillion in debt. So this was money that they were using for government programs. So they're actually borrowing this money that has to be paid off in the future in order to stimulate the economy today. And it's extremely inflationary. Of that $7 trillion, a lot of that money, you can see that it wasn't even used for COVID relief or for healthcare. It was used for entirely different purposes. So what this has done, money actually even went into people's pockets. So you've got $7 trillion that the government borrowed, put it into the system. That $7 trillion is chasing goods. That right there is very good reason or very good explanation of why we're in this new long-term secular bear market, high inflation, high interest rate, secular bear market. So what's the good news? So here's some potential good news. This chart I've got up now, it came from a good friend of mine, Scott Brown, at Brown Technical Insights. He's a very good technical analyst. And you can see that typically the summer months in the stock market are relatively weak, or they have been historically for a long period of time. That's been changing recently over the last 8 to 10 years. However, this is an election year. This is an election year chart. You can see that from past history. Election year stock market performance in the summer is historically pretty good. So you've got an up May, you've got a June that's up about 1.5%, and up July, and August is actually up about 1.5%. So you historically have a decent summer in the market, and then you have a pretty significant sell-off in September, October. Then the market rallies good toward the end of the year. So is this going to happen again in this election year? I don't know. Nobody really does. But I'd say the probabilities are there because we've seen it, a historical pattern. So that could be a potential good news. Another positive could be tech stock. This is a chart of the NASDAQ 100, which is a very tech-heavy chart, and you can see that it's continuing to make new highs. So what this shows you is if you compare this to the other indices that we just looked at, this is more tech-focused, and you need more than just technology in your portfolio. The bottom line is, how do we play this? How do we participate in this? Well, what you want to do is you want to make sure, this is very important, that if you're in the strongest assets, or perhaps a diversified portfolio with somewhat of a concentration in the strongest assets, you're going to be able to ride through this volatility. The odds are we're going to have a decent year this year. You've seen it on the previous chart. It's an election year, but you need to make sure that you're in the strongest stuff. That's what's going to hold up. Now, how do you know you're in the strongest stuff? You need to look at the individual, the asset allocation in your portfolio. So I've got a question. Do you know what you own? Do you really, truly know what you own in your portfolio? It's important. It's extremely important, particularly in this year if you want to have these gains. So if you want me to look at it, I'd be happy to look at your portfolio. You can reach me, 949-497-6366. It's dahlcapitaladvisors.com, Scott@dahlcapitaladvisors.com. Certainly feel free to give me a call. I hope this is helpful, and I'll be looking forward to the next podcast. So thank you, and appreciate you listening.